I-bonds are the best investments right now. You can earn up to 11.5% without risk, which is not subject to state or local taxes. Although the official rate is 9.62%, this is the lowest rate you can earn. You can actually earn a higher rate of return, up to 11.5%. Savings bonds are issued by the United States government. Interest is added to the bond at the start of each month, much like a savings account, which is why they are called savings bonds. Savings bonds are non-marketable securities, so they cannot be sold. Instead, both the principal and interest are paid at maturity or when the bond is redeemed. The maximum term is 30 years. Thereafter, no additional interest is earned. They can be purchased commission-free at TreasuryDirect.gov. There are two types of savings bonds, Series I and Series EE. Series EE bonds pay a fixed low rate of interest. Series I bonds pay an interest rate that is part fixed and part variable. Currently, the fixed portion is 0%, so there is only the variable portion. In May 2022, the interest rate for Series I bonds was 9.62%, much higher than the Series EE bonds. A primary advantage of EE bonds is that they are guaranteed by the U.S. Treasury to at least double in 20 years, which corresponds to a guaranteed 3.5% interest rate compounded annually. But you must hold the bonds for 20 years to get this guaranteed rate. If you redeem the bonds before then, you will earn a very low interest rate, currently at 0.1%. The interest rate of an I bond is a composite of a fixed rate and a variable rate based on inflation. Both the fixed rate and the variable rate are set twice annually by the United States Treasury on the first business day of May and November. The fixed rate for individual bonds does not change over their 30-year life. The variable rate is based on the semi-annual inflation rate over the previous 6 months for which inflation data is available. The variable rate applies to all outstanding I bonds for 6 months, regardless of the issue date, even if the government sets a new rate during the 6-month term in the bond. Interest is added to the account at the start of each month, but the added interest does not earn additional interest until the next 6-month period after the issue date. Therefore, interest is compounded semi-annually from the bond's issue date. However, you earn a full month of interest if you own the bond for any part of a month. If the bond is redeemed within 5 years, then 3 months of interest is forfeited. This is the formula for figuring the composite interest rate. Currently, since the fixed rate is 0, the composite rate consists only of the semi-annual inflation rate, which is annualized to make it easy to compare it to other investment returns. The equation for the composite rate has 2 terms based on the fixed rate, but the last term does not add much. However, when they become available, buying I bonds with a higher fixed rate, even if the inflation component is lower, may be a good investment, since the fixed rate never declines over the 30-year life of the bond. The fixed rate was as high as 3.6% on bonds purchased from May to October 2000. These bonds are now earning 13.39%. Investment returns of I bonds can be better than the stock market. The S&P 500 index was at 2381 in May 2000. It recently peaked at 4914, an increase of 206%. Compare that with the 359% return of an I bond purchased in May 2000. I could not find information on how the fixed rate is determined, but in the past, it was higher when inflation was low and market interest rates were high. So I believe the fixed rate is adjusted to make savings bonds competitive with other interest-paying investments. The fixed rate may soon rise if the Fed continues to raise interest rates and inflation subsides. Here's an example on how interest rates are applied to your bonds. You buy a bond on April 1st, 2022, when new bonds earned 7.12%. This interest rate applies to your bond for 6 months. The next month, the federal government sets a new interest rate for new bonds on May 1st, 2022 to 9.62%, but you continue to earn 7.12%. At the end of 6 months after your purchase, October 1st, 2022, the interest added to your principal starts earning interest, so interest is compounded semi-annually. The new 9.62% interest rate set for new bonds applies to your bond at the start of October 2022 to the end of March 2023, regardless of the new interest rate that will be set on November 1st, 2022. Your bond will start to earn that interest in April 2023 for the following 6 months, and so on. Interest rates are annualized. The publicized interest rate is the lowest rate paid. The issue date is the first day of the month of purchase, so you earn the full interest for that month, regardless of what day of that month the bond was purchased. In a bond's first 6-month period, the interest rate will be higher if the bond is not purchased on the first day of the month. The actual interest rate increases steadily the later the bond is purchased during the month, up to 11.5% if purchased on the last day of the month. After the first 6-month period, the interest rate will be the official rate. Here are some examples to illustrate this point. If you buy a bond on May 31st, then the issue date is May 1st, and your 6-month period runs from May 1st to October 31st. So you earn 6 months of interest in 5 months and 1 day. Thus, the 9.62% nominal rate yields an 11.5% actual rate. Nor does it matter what month you do this. If you buy a bond on October 31st, then your 6-month period begins on October 1st and runs until March 31st. So you are still earning 6 months of interest in 5 months and 1 day. So don't wait until the start of the next month to buy bonds. Buy now. Granted, this little tip isn't going to allow you to buy a Lamborghini for your next car, but during this hyperinflation period, every penny earned helps. Note also that it takes at least 1 business day to buy bonds, and it may take longer if you do not already have the funds in your TreasuryDirect account to pay for it. Bonds are not subject to either state or local taxes. However, bonds may be subject to federal taxes, but there are ways to minimize or even avoid federal taxes. The owner, who may not be the buyer, reports the interest and pays the tax. Taxes can be reported annually or deferred. However, the chosen method must apply to all savings bonds you own, including savings bonds you buy later. If you defer the tax, then taxes will be due when the bond is redeemed or matures. Co-owners must pay any taxes on bond interest that is proportional to the amount of money they contributed to the purchase price. So if a father pays 75% of a savings bond and his daughter pays 25%, then he must pay 75% of the tax and she must pay 25%, even if she receives the entire proceeds. This rule allows the choice of reporting the interest annually or when the bond is redeemed or matures. If the tax liability depended on who received the proceeds of the bond, then a choice between annual reporting and deferred reporting would not be possible. Accrual method taxpayers, usually a business or other entity, must report the interest each year as it accrues. There is no other option. Most people choose the deferral method since it eliminates annual reporting and defers taxes until the bond is redeemed or matures, which may be years in the future. However, low-income people, especially children, may benefit by reporting the interest annually. Taxes can be saved for children by putting the bonds in the child's name only and filing a tax return for the child and electing to report the interest annually. The child's tax rate will apply to the child's income, so if it is less than the standard deduction, then there is no tax and no need to report it. When the bond is redeemed or matures, then only the interest earned during the tax year of disposition will need to be reported, and only if the child's income exceeds the standard deduction. However, if the child receives significant income, then kiddie tax rules may apply, where the income will be subject to the marginal rate of the parent with the highest AGI. In this case, taxes on the interest may be deferred until the bonds are redeemed. The interest will be taxed at the child's rate if she is at least 19 years old, or 24 years old if she is a full-time student. Redemptions for younger children may be subject to the kiddie tax. Later on, I will be discussing how you could save on taxes if the bond proceeds are used to pay for higher education expenses. However, to take advantage of this program, the owner of the bond must be at least 24 years old on the issue date of the bond. This means that any bond owned by children will never qualify for this interest income exclusion. To take advantage of this education savings bonds program, the bond must be owned by a parent or guardian who is claiming the child as a dependent. The choice to report the accrued interest each year can be made either by your child or by you for your child. This choice is made by filing an income tax return that shows all interest earned to date on all U.S. savings bonds owned by your child, and by stating on the return that your child chooses to report the interest each year. Keep a copy of this return. Unless your child is otherwise required to file a tax return for any year after making this choice, your child does not have to file a return only to report the interest. This choice must apply to all savings bonds your child owns, including all future acquisitions. You may change from annual reporting to deferral by asking the IRS for permission, which is granted automatically. Detailed instructions, shown here, can be found in IRS Publication 550 under the section for U.S. savings bonds. You can also use Form 3115, Application for Change in Accounting Method, to change from annual reporting back to deferral. When the bond is redeemed, matures, or is reissued, then a Form 1099 will be issued to the bond owner, showing all interest earned by the bond up to that time, even if the interest was reported annually. A Form 1099 for bonds held electronically will be issued by the end of January in your TreasuryDirect account. You can find detailed instructions in TreasuryDirect. Form 1099 will report all interest earned on the bond, so if you previously reported some of the interest, then that interest must be subtracted on Schedule B. If you use tax software, as most people do, you must make sure that the software provides a means of subtracting previously reported interest. Otherwise, you will pay additional tax on that interest. Federal taxes can be avoided or reduced on interest used to pay for qualified educational expenses or for contributions to a Coverdell Education Savings Account or a qualified tuition plan, also called a 529 plan. To receive this tax-free treatment, the following requirements must be satisfied. If a bond is used to pay for your educational expenses or to fund your Coverdell ESA or QTP, then you must be the owner of the bond. To pay for expenses or contributions for your child's education, then you or your spouse or both must own the bond, and the child must be your dependent being claimed on your tax return. Your child may be a beneficiary, but not a co-owner. Qualified expenses must be paid to an eligible educational institution, which is any accredited public, nonprofit, or private college, university, vocational school, or other post-secondary institution. Qualified higher educational expenses include tuition and fees, but not room and board, required for enrollment or attendance. Qualified expenses also include contributions to a 529 plan or a Coverdell Education Savings Account. The expenses must be for you, your spouse, or your dependent. There are also some redemption requirements, the primary requirement being that the educational expenses must be incurred in the same tax year the bonds are redeemed. The tax savings for the educational bond program is limited by income, specifically Modified Adjusted Gross Income, or MAGI. MAGI equals taxable income plus additional income that would otherwise be excluded or deducted when calculating normal tax liability. For instance, IRA deductions would have to be added back to taxable income. The income limits phase out over a range of $15,000 or $30,000 for married couples filing jointly. The phase-out limits are adjusted annually for inflation and apply when the bonds are redeemed, not when they are purchased. This screen shows the formula and an example for calculating the tax-free portions of bond redemptions if MAGI exceeds the phase-out threshold, but is still below the phase-out limit. Simply multiply the redemption amount by the amount your MAGI exceeds the phase-out threshold, divided by the phase-out range, then subtract that from the redemption amount. If the bond proceeds exceed qualified educational expenses, then the percentage of interest that is tax-free equals the percentage of adjusted qualified educational expenses over the total bond redemption amount. Taxable interest equals total interest minus the tax-free interest. Form 8815 must be filed to exclude interest used to pay for qualified higher education expenses or for contributions to a Coverdell Education Savings Account or a 529 plan. You must name each person who is benefiting from the bonds proceeds for their higher education, as well as the names and addresses of the eligible institutions. Note that if the bond proceeds are contributed to a Coverdell ESA or a 529 plan, then you must add that to the name and address of eligible educational institutions in Section 1B of the form, as you can see from the example on the screen. Use the initials QTP to specify a 529 plan. Schedule B of Form 1040 is used to exclude the interest used to pay for higher education by subtracting the excluded interest from the total interest earned. You cannot avoid taxes by holding bonds in an IRA or other retirement account. While there is no legal prohibition on holding U.S. savings bonds in a retirement account, there are practical problems. As non-marketable securities, U.S. savings bonds cannot be transferred from your TreasuryDirect account to an IRA. Only cash, not property, can be used for contributions to retirement accounts. Therefore, paper bonds cannot be transferred to retirement accounts. Financial institutions, where most IRAs are held, also do not offer the option, probably because TreasuryDirect offers no option that would allow financial institutions to automate setting up a TreasuryDirect account for an IRA or other retirement account, so it would not be scalable for a large financial institution to offer this option cheaply. What about a self-directed IRA? Trusts can buy savings bonds, and IRAs are a special type of trust, but the trustee must be willing to set up a TreasuryDirect account. However, you cannot serve as the trustee of your IRA, even a self-directed IRA. A self-directed IRA may hold U.S. savings bonds if you can find a trustee who is willing to open a TreasuryDirect account and buy them with your contributions. I could not find any self-directed IRAs that offered the option of buying U.S. savings bonds in their marketing materials. Even if it were possible, there are many disadvantages to self-directed IRAs, so for most people, this would not be a good option. For any calendar year, these are the limits on the acquisition of savings bonds per recipient: $10,000 in electronic I-bonds, $5,000 in paper I-bonds. Business entities, trusts, and estates, including living trusts and estates, can purchase up to $10,000 of electronic I-bonds. These limits apply to each individual or entity per calendar year, whether the bonds are purchased or received as a gift. There is no limit to buying bonds as gifts for other individuals, but the total value of bonds received by the recipient cannot exceed the above limits for the calendar year. There are some exceptions to limits on bond acquisitions. The primary exception is that bonds transferred to you because of the death of the original owner do not count toward your limit. As stated earlier, bonds cannot be sold. Instead, they are redeemed by the federal government. Bonds must be held for a minimum of 1 year. If redeemed before 5 years, then the last 3 months of interest is forfeited. However, this penalty can be mitigated by buying right before the end of the month and selling right after the beginning of the month, since you earn a full month of interest if you own the bond for any portion of the month. A bond must be registered. Registering the bond determines who owns the bond and who can redeem it. The owner can specify a beneficiary, who must be a person, who will receive the bond if the owner dies. A bond may have another owner, but if one owner is a person, the other cannot be an entity. Either owner of a co-owned paper bond may cash the bond without the approval of the other owner, but most other transactions require the signature of both owners. If one owner of a co-owned bond dies, then the other owner becomes the sole owner. You can use your tax refund to buy paper bonds, or you could transfer some or all of your refund to your TreasuryDirect account. You can use Form 8888 to allocate some or all of your tax refund to your TreasuryDirect account. Although the limit on buying electronic I-bonds is $10,000, you can transfer more than that, since you are only transferring money, which does not automatically buy bonds. You would need to do that in your TreasuryDirect account. Note, however, that TreasuryDirect does not pay any interest on free cash, so it does not make sense to transfer more than what you intend to buy. Paper bonds are sold in these 5 denominations. These bonds must be purchased in multiples of $50, since that is the smallest denomination. The per calendar year limit is $5,000 per tax return. You can only buy paper bonds with your tax refund, which is limited to the lesser of $5,000 or your tax refund, by filling out Part 2 of Form 8888, Allocation of Refund. You do not need to open a TreasuryDirect account. Just follow the instructions of Form 8888. Once your tax return has been processed by the IRS, your paper savings bonds will be mailed to you. You can buy paper bonds for yourself and 2 other individuals, but the total purchase price cannot exceed the lower of your tax refund or $5,000. You can also designate co-owners or beneficiaries for the other individuals. Designate someone as a beneficiary by checking the appropriate box. You can redeem paper I-bonds at some local financial institutions or by mail. To redeem by mail, use FS Form 1522. If your paper I-bonds are lost or destroyed, then you can easily replace them with an electronic bond in your TreasuryDirect account or receive payment for the lost bonds. The paper bonds are then invalidated by TreasuryDirect. Individuals are limited to receiving $10,000 of electronic bonds and $5,000 of paper bonds, but you could buy much more than this for your family, or if you have various entities such as a limited liability company or a trust. Remember that each tax return is limited to $5,000 of paper I-bonds. So if you are married and file jointly, then $5,000 is your limit. But if you file separately, then your spouse can also buy $5,000 of paper bonds for a total of $10,000. You can also add up to $10,000 for each entity that you own or control. Remember that all of these limits are per calendar year. To buy bonds commission-free at treasurydirect.gov, you must set up an account. Go to the website and select the tab for individuals. Click the link to open the account. Click on the link to TreasuryDirect. This shows you a summary of the 3 steps you must take to establish an account. To get started, click on the Apply Now button. The only thing you will need to open an account is your personal information, your Social Security number, a checking or savings account, and an email address. Enter your name, Social Security number, and other requested personal information. Enter your banking information and email address. Click the checkbox to certify certain information. Review the information to ensure that it is correct. Then click Submit. Choose a personalized image or caption that will help to verify that you are on the authentic TreasuryDirect website. Choose a password and the answers to at least 3 security questions. Then click Submit. Then you reach the final screen thanking you for opening an account. TreasuryDirect has good videos on how to use their website and how to do the most common tasks, such as setting up an account and how to buy bonds. Just search for TreasuryDirect videos, then click on the appropriate link. You can see their current selection here, which will be expanded in the future. Each video is only 2 minutes long. Topics include setting up an individual account, setting up an entity trust account or a corporate entity account, how to buy and deliver savings bonds as gifts, how to reset your password, and how to edit your bank account information in TreasuryDirect, as well as other topics. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at thespanner.com for more than 850 in-depth fundamental tutorials on personal finance, investments, and economics. Check out my books on money at williamspalding.com. Thank you.